Good morning, everybody. This is a very different day from the morning of February 11th. And my notes here this morning say February 11th, 2010, which is when I was scheduled to speak. And I think that was the second blizzard. The first was on the Saturday, and the second might have been on the Wednesday, and the 11th, I think, was a Thursday. I want you all to know I was here. I couldn't find Yash or Sally. None of you were here, by the way. Actually, a few of us had fun staying downtown the night of that second blizzard. We had a fun board meeting, and I see a few colleagues here. A few of them may have stayed downtown with us. We had about 150 people camped out at the Renaissance, and it was actually a pleasant, quiet night, and it was very different from kind of the chaos of commuting in snow. But nonetheless, I can't think of two more contrasting days than February 11th and today as I look out this beautiful panorama around the harbor where everything looks so delightful today. In terms of Yash's very negative comments on Harvard Business School, Boston, the New England Patriots, if you see a very middle-aged person this weekend at Camden Yards wearing a vintage Carl Yastrzemski number 8 Red Sox shirt, it is not me. It will not be me. It will be someone who looks like me, but nonetheless. I wanted to do a couple of things this morning, but before I get into my couple of topics, I was reflecting a bit on the first one of these events I came to, and it was with Sheila Bair, head of the FDIC, and I can't remember the date, but I believe it was in the fall of 2007. 2008? Fall of 2008. And I've made a little bit of a part-time career lately out of reading what I call the pile of crisis books that have been published. And I reflect back on Sheila's presentation that day right in the midst, and it was probably October, November, again, I can't remember the exact date, and just thinking, what did she know that she wasn't telling us? And when you go back over time and you read some of how precarious things really were at that point, you realize she knew a lot more than she was telling us. And it was a fascinating time, and it really began a period of financial stress like most of us have never seen. It actually began in the second half of 2007 when there was a breakdown in some money market funds and some mortgage securities portfolios. Bear Stearns first got into trouble in the summer and second half of 2007. We lived through the Bear Stearns thing, we lived through the Lehman Brothers thing, we lived through Fannie and Freddie and AIG and Washington Mutual and all of the bank failures. And it really was an unprecedented time. And again, I see a handful of my colleagues out here, and my friend Rob Gensler, when I talk about financial crises, he's just nodding up and down like, oh yes. Thank God it's over, and in many respects it is over. However, from the time of my notes on February 11th, things have changed. And it's remarkable how quickly the environment can change, because on February 11th, I had nothing here about Greece or about Goldman Sachs. And proving how dynamic markets are and how dynamic financial crises and their resolutions are, we have gone through an absolutely remarkable time. So I want to do a couple of things. I actually have 4 things to talk about. I just want to tell you a little bit about T. Rowe Price, and then I thought I would talk a bit about the financial crisis, how different organizations tried to respond to the crisis, and I will take you a little bit inside what was going on with T. Rowe Price at the time. And then we'll talk about perhaps a few lessons learned, and if we have time at the end, maybe a couple of observations on financial services reform, which is a current topic and very much on the front pages of the newspaper. Actually, financial services reform will be on the second page of the newspaper. The hearings with Goldman Sachs yesterday will be on the front pages of today's newspapers. But nonetheless, let me begin. In terms of T. Rowe Price, again, reflecting on a comment Yash made about Harvard Business School, I recall taking a class circa 1981 on managing professional service firms and how different they are from real hierarchical organizations. And I was reflecting again on Bill Sullivan from Agilent Technologies, who was the last speaker in this series about a month ago. And Bill stood up and talked about how hierarchical and structured Agilent is around the world and how the pyramid works, and how in essence, how they have many challenges, but a company like that is fairly easy to manage. Again, as my colleagues know, professional service firms, investment organizations, law firms, accounting firms in some respects, where people are the key asset, are very difficult to manage because we have no real degree of fixed investment. Our assets are our people. And there are a lot of people in companies like ours that are fairly hard to manage, suffice it to say, from time to time. I'm not looking at anyone in particular here. There are no cheaper price people I'm looking at. But it's difficult to manage firms like ours, and we tend to be fairly decentralized. The investment people operate in a fairly autonomous way. And in a time of financial crisis, it's really tough to keep the place glued together, I think, as we found out in 2008. But just a bit about the company. We were founded here in 1937. A couple of us were talking earlier about our ID card numbers, because that designates really when you were hired by the company. And I joined Price in 1982, and there were about 300 people in the company at that time. We were a very small company. We fit on 2 floors over at 100 East Pratt Street. Everybody in the company was at 100 East Pratt Street. My friend Rich Palmer was at 100 East Pratt Street in 1982. And it was a very small company. Everybody knew each other. We weren't particularly global. We were very US-centric. We had a handful of products, and it was a fairly easy business to run. Flash forward 28 years to today, we now have 5,000 people, roughly, in a dozen countries around the world, albeit the majority in Maryland. We manage about 410 billion assets for literally millions of clients. The smallest client in the firm would have assets of roughly probably $1,000 in a mutual fund account. Our largest client would have $10 or $12 billion with us. So there's a wide range of clients that we serve. We went public in 1986, where we've been publicly traded since 1986. We have a market value of about $14 billion, plus or minus $1 billion, depending on the day. I think we maybe lost $1 billion yesterday, I'm not sure. And we really pride ourselves on our primary focus is doing a really good job for our clients. I am a small hub in the wheel. We have a 7-person management committee that runs the organization. I'm the chairman, Jim Kennedy's the president, Ed Bernard's the vice chairman, and we divide up areas of responsibility. And again, it's very different from managing IBM. And you can't interfere too much, and you have to guide the organization without micromanaging the organization. I think that's one of the ways professional service firms get into trouble when there's too much micromanagement involved. So let's talk just a little bit about what we've been through. And it certainly has been an interesting time, and there has been a lot written. And it struck me again watching some of the Goldman hearings yesterday in terms of just how so many people lost sight of what they were really trying to accomplish in the post-dot-com bear market recovery of 2003 to 2007. And the Fed lost perspective, policymakers lost perspective, individuals lost perspective, homeowners lost perspective, investors lost perspective. People always ask, who was to blame for the financial crisis? And I always say there's a lot of blame to go around. When you look at what the Fed did post-2002, clearly they helped to create a real estate bubble. Policy initiatives in Washington designed to increase home ownership and encourage people who shouldn't buy homes to actually buy homes. In terms of borrower behavior and lender behavior, there is equal blame to go around. Investors around the world bought some of the sliced and diced mortgage securities, again, we were hearing about yesterday in the Goldman Sachs hearings. Banks did reckless things. Investment banks took on too much leverage. Who ever thought of an investment bank with 35-to-1 leverage? If you have 35-to-1 leverage and your assets drop by 3%, effectively you're insolvent. In the old days, investment banks had 15-to-1 leverage, maybe 20-to-1 leverage. So we saw an incredible increase in leverage across the system. And then we saw a remarkable acceptance of financial complexity. When you think of all the crazy mortgage products that were served up around the world, I mean, which rocket scientist ever invented the no-doc home mortgage? That is a mortgage you apply for. You don't have to show them anything. You just go into the branch of Countrywide and you basically fill something out, and next thing you know, you're in. Or my favorite, the interest-only, negative amortizing, adjustable rate subprime mortgage. I mean, you have to slice and dice that to figure out what the components of the mortgage basically mean. But mortgages like that allow the now highly reported individual in California making $20,000 a year to buy a $700,000 house in Bakersfield. No money down, borrow $760 because that'll cover your closing costs. You have a teaser rate up front. You're only paying 1% interest for the first 3 years. You can afford that. And then after 3 years, bad things begin to happen. Who knowingly today would enter into that type of an arrangement? It just wouldn't happen. And so we had too much liquidity, rates were too low, crazy stuff going on in the real estate business that we now read chapter and verse on. How could the subprime loan market become 40% of the US mortgage market? Again, just reckless behavior on the part of individuals and lenders and mortgage originators. Leverage. How could debt in this country grow to the level it did? How could investment banks do it? How could the individual do what they did? And then in terms of financial engineering, I think what we have embarked on since 2008 is a path towards financial simplicity. You see it in terms of investment products. You see it in terms of mortgage products for individuals. And I don't think we will see interest-only, negative amortizing, adjustable rate subprime mortgages for many years to come. Now, I'd like to tell you a brief fairy tale on how this all played out. So once upon a time, there was that individual in California I mentioned, and he really wanted to buy a house. He didn't have very much money, so he went to the local mortgage originator. I say that, and I don't say that the old-fashioned local bank, because there was a whole new level of involvement in the mortgage business. Went to the local mortgage originator and said, I'd really like to buy this property to live in, and the originator says, do I have a deal for you? Hence the interest-only adjustable rate, negative amortizing mortgage. The appraiser gets into the works. There was a lot of collusion between sellers and real estate agents and lenders and appraisers. And so the borrower takes out a loan that he or she has no capability to ever repay on a house whose price is escalated at twice the rate of inflation for the prior 10 years and moves in. So the mortgage has now been transferred and packaged to either Bear Stearns or Lehman Brothers. I will pick on them because they're no longer in existence. I won't pick on poor Goldman Sachs because that would be piling on, I think, after the last week. Bear Stearns and Lehman Brothers take this mortgage and package it into a residential mortgage-backed security, cut it into tranches, aided and abetted by quants in their firms, and then walk down to see Moody's and S&P. And Moody's and S&P look at the packaged securities and say, oh yeah, these are really well diversified. I think they're AAA. So we have diversified subprime portfolios that are rated AAA because they're diversified by borrower and region and type of property. So the AAA mortgage-backed subprime security rated now AAA is now sold to an Icelandic bank because Icelandic banks want to invest in higher yield securities. And so the Icelandic bank then buys the mortgage-backed security. Then, what we will do is we will issue CDs because people in Europe really want high-yielding CDs. So a little town in the UK buys a high-yielding CD from an Iceland bank that is based on the mortgage that came through New York City via California, and everything's great. The little town in the UK now has more money. They're making more money in their investment portfolio and their pension fund, and they go out and hire a new teacher and a new policeman. It's perfect. What happens when too many houses are built? Everything reverses. So the house prices in California have been so bid up, and there is so much supply, and there has been so much construction, that now the value of houses begins to slowly fall. This is in 2006, early 2007. Maybe it even began in 2005 in some respects. With prices beginning to roll and a lot of supply, there's no new construction. So what happens? A lot of home builders lose jobs, right? The weakest borrowers slowly begin to realize that that mortgage they took out, they're in deep trouble on. They slowly begin to default. This all takes place really slowly. It's a little bit like an avalanche. It sort of begins slowly and then accelerates. Some of the mortgage-backed securities then begin to decline in value, although that probably took almost 18 months for that decline to begin to occur. If home sales are down, you really don't need the mortgage originators and the appraisers, so they're not hiring people anymore. Now all of a sudden the bank in Iceland has a problem because they have to mark down the value of their investments against a very small equity base. So that becomes a big deal. The Wall Street firm's position in these same mortgage backs, pursuant to what Goldman was talking about yesterday, begin to decline. The value of the securities goes down. Now the Icelandic bank is in a default position. They don't have enough equity. And so they default. Now the holder of the Iceland bank CDs, that little town in the UK, they have a problem. Their CD is not worth anything. So what does that little town have to do? They have to fire the policeman and the teacher that they had just hired 3 years before. And so this is what we lived through. This is a little bit fabricated, obviously, but the flows are really what were occurring. And it took us into a position in late 2008, again, when you read the litany of crisis books, where we were in a position where the financial system was, in essence, on the brink. Confidence in the system was at an all-time low. Many organizations faced liquidity crises. We had bailouts. We had TARP. We had a crisis that basically took 6 months to work through. And I'll call that from, forget Bear Stearns, I'll call that from September 2008 really into March 2009. It took basically 6 or 8 months to get everything really glued back together again. So what was going on during this time? And let me talk about, I'm going to talk about 3 companies. I'll talk about T. Rowe Price. I'll talk about, and then JP Morgan versus Citigroup versus Lehman Brothers, just to give you some idea what was, what organizations were doing and how they were responding to this crisis. In our case, it was I'd say a situation where we felt as though as 2008 was unwinding that things would probably hold together more or less. We got through the Bear Stearns rescue on March 17th, St. Patrick's Day. I distinctly remember having a glass of Guinness thinking, wow, this is not a good St. Patrick's Day. Bear Stearns, in essence, failed over the weekend and was acquired over Sunday night into Monday by JP Morgan Chase. That seemed to hold things together because Bear Stearns had been the source of so many problems in 2007 with its leveraged mortgage-backed securities funds. So it felt as the spring unwound in 2008 as though, you know, maybe Bear Stearns was an isolated case and maybe things will be okay. Then over the course of the summer, things began to fall apart with the Fannie and Freddie crises. Lehman Brothers, which had ample time to save itself or sell itself, by the time we got to Labor Day, was in a very serious state. And of course, over the weekend of September 14th and 15th, September 14th being a Sunday in the fall of 2008, Bear Stearns, in essence, failed. Merrill Lynch went into the arms of Bank of America because, in essence, there was a run on the bank. These organizations had to mark down their investment portfolios so dramatically, and they didn't have the capital, nor did they have the liquidity to meet investor demands. So September at T. Rowe Price was a very interesting time, and I'd say we, you know, the first thing you do is make sure that, you know, your organization has enough liquidity, and that's never been our issue, as my colleagues know. We always have plenty of liquidity in our company, so we weren't really worried about our balance sheet. We were worried about declining asset prices because that directly affects our revenues. But in terms of our financial position, we figured it would take a lot more than that to get through. So we weren't really worried about the viability of the organization. I'd say as the fall unwound, or as we approached December, we were in a position where we were faced with some really tough decisions in terms of cost control. And so in our organization, again, much to the chagrin of some people in this audience, the easiest thing for us to do is cut our compensation pool. And so that was really the first decision we made in the fall of 2008. And then you put in a slow, gradual hiring freeze, and ultimately you have some other levers you can pull in terms of your income statement, like charitable giving, which you can squeeze if you have to. And so we took a lot of those steps beginning in the fall of 2008. And then one of the big challenges, of course, in an organization, an investment organization, is to maintain morale. And this is where communication is so important. And this is where Jim Kennedy, Ed Bernard, and I, and Bill Stromberg, the head of our equity division, spent so much time communicating both internally and externally. And you have two constituencies. And for me, they were clients and also our investment people. Because suffice it to say, it was a very, very unsettling time. And there are some people, not just T. Rowe Price people here, some other folks from different investment organizations, and it was a scary, scary time. So we embarked on kind of an aggressive internal communication campaign. I actually have a series of internal memos here. My favorite, and I won't go through all of these in the interest of time, but a couple of them are worth noting because the dates were somewhat significant. Perhaps the biggest understatement was in a memo we sent to all employees on September 17, 2008. That is 2 days after Lehman, Merrill, and AIG was about to fail that day. I was about to receive a government bailout on the 17th. The understatement of the year, quote, "The collapse of substantial and well-known firms and the accompanying market turbulence can be unsettling." Now, what we meant to say was, oh my God. We continued, our firm's financial position remains exceptionally strong, our balance sheet is solid, and we have abundant reserves and liquidity. Our management strategy has positioned us well, and we continue to invest in our organization to make sure, or to ensure our success in the future. That was the easy one. Okay, we thought we'd get through that week. Fast forward, October 2nd. Since our message 2 weeks ago, turmoil has continued. I'm liberally excerpting here. Many of you have asked how T. Rowe Price is different from some of the firms that have collapsed. Many firms borrow money, sometimes great deals of money, to fund their businesses. This leverage enhances returns, but unfortunately magnifies losses in bad markets. By contrast, we try to manage our company's financials very conservatively. Markets will remain volatile, and clients will continue to be anxious. The best thing we can do is help to reassure them through our investment activity and the service and conversations we have. Please know how much we appreciate your efforts. Let us, one of us, know if you have any questions. So that was okay, and of course, an interesting thing about a company like T. Rowe Price is more than 80% of our employees are stockholders in the company. Fast forward October 10th, another email to 5,000 people. What does our stock price reflect? In 4 weeks, our stock had gone from 65 to 26. There was no question about the viability of our company. We had no debt. We had $1 billion in cash on the balance sheet, but the market was very unsettled and frightened of financial services companies. A sharp price fall in our stock price in the short term generally doesn't make that much difference in the long term, even when it can be a little bit frightening. We have seen this occur before. However, as our stock price declined sharply in other crises, and this is when we became historians, such as 1987, 1990, 91, 2001, and 2002. After each downturn, we always emerged as a stronger competitor. With all of your hard work, we firmly believe that this will continue to be the case. So that was to address the concerns about our stock is going down. Should we sell it now? And so if we had 5,000 employees, we had probably 4,000, including yours truly, who were thinking, is it all going to go away? Are we Lehman Brothers? Are we Bear Stearns? Our business was very different. Our balance sheet was very different. But in the heat of 2008, that fall, it was not wholly clear. So we get to the end of November, and things were a little bit better. We talked about working hard to control expenses, and we tried to preview the fact that our earnings would be down in 2008 because we thought that was important to deliver in advance of compensation season, so I won't get into that one. And then in January, we announced our earnings for 2008 and had to explain about the impairment charge we took because the value of our investment portfolio had declined. That was a massive attempt to try to translate FASB pronouncements into a communication for 5,000 people, and it took a lot of time to do that. In our spring 2009 annual report, we talked about how it was the periods like 2008 test our mettle, but we have dealt with adversity before and have emerged from prior downturns in a position to succeed. Strong organizations can withstand the challenges of a demanding environment, learn from the experience, and emerge stronger after a period of adversity. We believe we are such an organization. So it continued, and the point of these references is to really try to communicate how important communication is internally, and these are all internal communications, in a period of financial crisis. And at the same time, there were massive degrees of effort focused on communicating with our clients. And we have two broad categories of clients. We have the individual investor, the mutual fund investor, and the big institutional investor. And I won't have even ask someone like Rob how much time he spent on the phone in the fall of 2008 trying to reassure his clients around the world that we knew what we were doing and that our organization was not like some of the others who met their unfortunate fates. So there were massive efforts to communicate externally with all clients. I remember doing at one point a video with Steve Forbes, which I dubbed the Irrational Pessimism video, where our contention was that in the fall of 2008, investors had become irrationally pessimistic, which was a little bit of a takeoff on Alan Greenspan's Irrational Exuberant from a number of years prior. 2009 was a little bit better time, and we had a number of communications in 2009 as well. Interestingly, clients in 2009 began to feel much better much more quickly. And not surprisingly, because starting the first week in March, global financial markets began to rebound quite sharply. and our clients around the world began to think that the folks at 100 East Pratt Street have not lost their minds, and their returns in 2009 were quite strong. So communication and morale support in a time of crisis are, I think, perhaps the two things that we took away from a time like 2008 when it seemed like everything could fall apart at any moment. And in terms of strategy 5, and was really, I have written down, ride out the storm. At some point you've done all you can do. You've tried to bolster morale, you've cut costs. In our case, early in 2009, we made the unfortunate decision to lay off roughly 4 or 5% of our workforce. By the way, we're hiring many of them back right now, showing how cycles work. Once you communicate extensively externally, once you communicate internally all the time, once you've done all that and you know your balance sheet is in a strong place, all you can do is wait. And waiting is what we did through the early part of 2009, and then as 2009 unfolded, things got a little bit better. Now let me just talk for a couple of minutes, and I guess we're okay on time. Sally, Yash, okay. About a couple of contrasting cases, JP Morgan, Citigroup, and Lehman Brothers. And for those of you taking notes, I have 4 what I call differentiating factors defining success. And the 4 items are capital structure and liquidity, seasoned management culture, direct management engagement in business, and risk controls and complexity. And you could almost do an array of those 4 criteria or those differentiating factors, and across the top write JP Morgan, Citigroup, and Lehman Brothers, and begin to write notes about each. And I think in terms of one of the lessons that we've taken away from the crisis is in terms of item 1, capital structure and liquidity, leverage really is the enemy. And I think the only reason, and I picked JP Morgan, Citigroup, and Lehman because JP Morgan got through things generally unscathed. Citigroup got through with a great deal of government assistance. The federal government now owns about 35 or 7% of Citigroup. And of course, we all know what happened to Lehman Brothers. And in descending order of strength, capital structure strength, and good liquidity, you have JP Morgan, Citigroup, and of course Lehman Brothers. Lehman Brothers took its leverage up so dramatically in the 2004 to 2008 timeframe that it was virtually irresponsible in hindsight. Now at the time it looked like we're trying to really grow our return, increase our return on equity. In hindsight it looks wholly imprudent. Citigroup is a little bit in the middle. Citigroup is with us today courtesy of the US Treasury and the Federal Reserve System. And of course JP Morgan always insists that it didn't need TARP. Taking TARP was forced upon it, and it had the wherewithal to ride through the crisis. Management is so important, and I think of how much turmoil there was at the top of both Citi and Lehman Brothers over the 5 years preceding 2008. Lehman Brothers' top management suite, with the exception of Richard Fuld, was a virtual revolving door. People came and went, people were reassigned. It was a bit of no one really knew who was in charge of what, except for Dick. That was not a good management culture to get you through a crisis. Citigroup was a little bit in the same position, although not as severely affected as perhaps Lehman Brothers was. And again, at JP Morgan Chase, things held together fairly well in terms of the management structure. In terms of engagement in the business, again, for those of you who have read some of these crisis books, the one thing you come away with in the case of Lehman and Bear Stearns, and also Citigroup to a lesser extent, is were the folks at the top really engaged in the business? And sure, writers take journalistic license from time to time when they write books. But the very concept of management at Bear Stearns being at a bridge tournament when the company's falling apart, even if that's 5% true, doesn't really pass the sniff test. What was going on at Citigroup, you had so much turmoil that it was not clear to me as an observer that the people at the top of Citigroup were fully engaged, understanding what was going on in the business on a day-to-day basis. And I think at JP Morgan Chase, one of the reasons they were relatively unscathed was they were firmly involved, and you had a seasoned team who really understood the various businesses the company engaged in. And then in terms of complexity, I said earlier that in some respects we're in for a future of financial simplicity. That crazy mortgage I described that I can't even repeat without looking at my notes, you won't see that for a while. And I think so many newfangled products came along in terms of what Wall Street firms are creating that, you know, I defy any of the managements of the companies to actually explain the securities that were being created by their organizations. And I think people really get carried away and they didn't know what they own. One of the fundamental things an equity investor always tells him or herself is know what you own, understand what you own, understand what the company does if you have an investment in it. Some security creation became so complex, people didn't know what they owned. And I think that gets into the issue of risk controls. People had very sophisticated risk models, but the risk models didn't accurately reflect what might happen to some of these complex securities. And so again, in order of descending success, you had JP Morgan, who did a pretty good job in terms of risk management. You had Citigroup way behind, and then Lehman was virtually off the charts on the downside in terms of understanding the risk of the business. Lehman did something else. They were so envious. It was very amusing to read of some of the private equity firms, whether it's KKR or Blackstone, and how much money these folks were making, that they wholly levered up their balance sheet to make direct investments in private equity deals. That is not a good thing to do if that takes your leverage from 25 to 1 to 35 to 1 after a period of 5 years of bull market stock price moves and subsequent very expensive private equity deals. So when we think of organizations that sort of scratch their way through the crisis well, I think these are four very interesting criteria to reflect on. And in the case of our organization, you know, we never worried about our capital structure and liquidity. We think we have a seasoned management culture. I mean, we're all pretty old, if that's we've all been around for a long time, if that's a measure of that. I'd say members of our management committee have very close engagement in our business. We have a simple business. It's a much simpler business than perhaps the business with Goldman Sachs, but we're very engaged in understanding the clients and how we deliver investments and how we manufacture and supervise our investment process. And in terms of complexity and risk controls, again, I think our business is a very simple one when you actually look at it. So we were never worried about complex securities. We stayed out of a lot of really crazy stuff on the mortgage side in our fixed income group. And in terms of risk management, interestingly, risk management is a very popular topic today. I would say most of our focus on risk management has been occurring starting in 2008 and after. So it is an area now that we're looking and spending a fair amount of time on. But I'm not sure I would say that in 2005. It was kind of an infant business in 2005, the entire risk management field. And the crisis really spawned a takeoff in how risk management has evolved as a management discipline. So those are just a couple of perhaps lessons and observations on the crisis. We put out a piece for our client conference in the fall that talked about a number of other things. I will rattle them down and then I will stop perhaps and take questions depending on how we're doing on time. Number one, watch liquidity. We spoke about that. Balance sheet strength matters. An item that was somewhat controversial, but as my example points, I think is relevant. We are all connected. When markets are under stress, they all move together. As an academic would say, correlations go to 1, and there is no safety in diversification. Here's one of my favorite beliefs, and it's been true for a long time in my view. Financial innovation helps Wall Street, but not Main Street. And I think if you looked at the Goldman hearings, you would take away with that. Get a map of Washington. Clearly in terms of financial services reform, I think any company spends more time worrying about regulation than it did several years ago. And clearly in the financial services sector, we spend a great deal of time worrying about what Washington's up to. Simplicity is a virtue. If it sounds too good to be true, it probably is, one of my favorite investment maxims. Another one that we learned the hard way, it cost us $100 million in 1990, and that is don't reach for yield in a money market fund. And because of that very expensive lesson we learned in 1990, and again, I see a few heads nodding up and down, we didn't do that this time. We made that expensive mistake before, and that might have saved us from a much more expensive mistake in 2007, 2008. Again, my favorite maxim, I was viewed as kind of a crazy person running around T. Rowe Price all the time saying, remember, folks, the world isn't ending. The world doesn't end that often. And so I said that repeatedly, I don't know how many times. By the way, I had no basis for that assertion, but it felt like the right thing to say at the time. And lastly, and I think as we're watching right now from the time of February 11th to today, we will have other crises. And I think what we're going through right now, observing Greece and some of the other European markets, and perhaps what might be going on with, I don't think Goldman's a crisis. I think Goldman is just an interesting lesson in how everybody spends their time in the crosshairs of somebody. But we will have other crises prospectively. We will have other market turmoils. We will have other things that scare us as an organization, and all you can really try to do is do what we did in 2008 to keep our organization together and focused on trying to serve our clients. So with that, it's 8:45. I didn't get into financial regulatory reform, which we can, if anyone has questions, we can talk about.
You said in the very beginning, I think, that the Fed had lost its perspective and that rates were too low and too much liquidity in 06 on, I guess. Would you think there's any change in that at the present time?
Yeah, could everyone hear the question? On the Fed, I implied the Fed may have been too accommodative in 2003, 2007 in an effort to reduce rates, and that contributed to the housing bubble, in essence. And where are we today? We're in a similar position. I don't want to be too hard on the Fed. Again, if you go back in time to 2001, 2002, that was a bit of a scary time too. And so the Fed made what it thought were good decisions to try to get the economy going after the 2000, 2002 recession. Now that wasn't as bad a recession as what we've just gone through, and that was almost more an equity market crisis than an economic crisis. But the Fed thought it had to cut rates to really get the economy going again, which is what the Fed typically does in a period like that. They probably, in hindsight, and I think one of the reasons you see Alan Greenspan on every media show he can be on, and he would never talk to the press for his first 80 years of his life, I think he's trying to sort of work on his legacy, and he's trying to defend what the Fed did. I think in hindsight, he'd probably admit that they moved rates down too far, too sharply for too long a period. But again, at the time, it seemed like it was not an unreasonable thing to do, given how frail the economy felt in 2002. Today, I think we're in a really interesting position because my own view, and this is an individual view, not necessarily the view of anyone else at T. Rowe Price, is that if it weren't for the financial crisis, if this had just been a serious recession, short rates, Truman, would be about 100 basis points higher than they are anyway. So I think the fact there was a global banking crisis caused rates to, in essence, go to zero. And I think my sense is that the Fed has been looking at all of the economic news coming out thus far in 2009 and the corporate news, and almost everything's been better than people expected. And so I would guess the Fed will move to raise rates before the end of the year on the short end. I bet they'll take bigger steps than they would have taken otherwise. I think the first step, my guess would be 50 basis points. And I think, Bernanke is a student of history, and he's a student of, the Greenspan reign, if you will. And I think he's very worried about becoming, or having a monetary policy that results in too much liquidity and creates inflationary expectations in the future. So I think you'll start to see them move at some point. Yes?
Hello. I just wanted to ask, yesterday during the Goldman hearings, at one point, well, first off, there was definitely a lot of political rhetoric that was being said back and forth, but at one point they asked one of the executives at Goldman flat out, as a financial expert, how would you recommend that we go about doing the financial reform? And I just wanted to see if you had any takes on what you would suggest to the government on the best practices for financial reform.
Okay. Well, thank you for not asking me about emails. You've asked a much easier question than the email question. There are so many proposals. To me, there are a few steps that you take when the patient is really sick. And so you try to attack the cause of the patient's problems. And when you look at what transpired, the problems were caused, in my view, by too much leverage and consequent lack of liquidity, crazy behavior in the derivatives markets. The world was a fine place to live and work for years before the creation of credit default swaps. The American Industrial Revolution occurred without credit default swaps, the technology revolution, et cetera. And then there was a lot of particularly in the first part of 2009, when the market was very fragile, there was a lot of rumor mongering. And there was a lot of crazy short selling stuff going on, buy credit default protection, start a rumor. There was a lot of stuff going on. So I looked to a couple things. First, because all investment banks now are banks, the leverage problem has begun to go away. And you could see that in the Goldman Sachs balance sheet at the end of the first quarter. No more 30 to 1, 25 to 1, more like 13, 14, 15 to 1. That's a good place for a Wall Street firm to be. So I think by all of the major broker-dealers converting to banks to get access to the Fed discount window, in essence, as part of the crisis, you have taken away the excessive leverage risk, in my view. And I think responsible boards will be focused in on balance sheet structure of these firms going forward, much more so than they did historically. When the more leverage you had, the higher your return on equity was. So I think there's a return to sanity there. In terms of derivatives markets, credit default swaps, CDOs, synthetic CDOs, I think that stuff has to trade on an exchange. There has to be more standardization. That would eliminate a lot of the crazy stuff that went on with credit default swap and rumor mongering. Lastly, in terms of hedge fund activity, short selling, rumor mongering, the SEC did put forth a rule that would limit short selling if a stock is down 10%. In my view, they should have reinstated the uptick rule, which was the easy thing to do, and that would have eliminated a lot of market fragility in times where confidence is at issue. A lot of the other provisions, I think there were good moves to simplify the bank regulatory structure. Back to Sheila Bair being here a couple of years ago, I think getting rid of the Office of Thrift Supervision probably makes sense. There are a couple of things I don't think that make any sense. The Council of Regulators, that it will be put together to save us from future financial crises. It won't work. I mean, we had the smartest people in the world worried about the crisis that developed in 2008, and they weren't able to prevent it. And so I think we're deluding ourselves if we think we can get a team of 8 people together, whatever the number is, make them the super regulator council, and they will prevent future busts. So that's very politically appealing, doesn't make any sense to me. Some of the VOCA rules in terms of divesting proprietary trading, I'm not sure that makes sense. The big banks will get around it anyway. The Consumer Financial Protection Agency inside the Fed, I think we have existing authorities to deal with a lot of these issues, but that's very politically popular and probably gets through in some way, shape, or form. Governance reforms, I don't think have anything to do with what transpired. And so I think that's like giving or operating on doing some cosmetic surgery on the really sick patient when you should be doing some of these other things to save the patient's life. Those are a few things I'd focus in on. But I think already, because we went through so much pain, the seeds of the healing process are already in place, and specifically the fact that all the major broker-dealers are now regulated banking institutions. Yes?
Well, first off, congratulations to you and your associates for the great exercise of common sense for so many years. I think it puts you in such a great position. In that context, as you have a huge stake in the healthy financial markets, but not a huge stake in some of the stuff that went so crazy, are you able and are you effectively trying to get your voice heard when it comes to regulatory reform? Do they listen to T. Rowe Price?
Bruce, I think it's fair to say that we talk a lot and people listen. Whether they hear us is a separate and obviously important related question. I would say a handful of us have spent more time in the last 2 years talking with elected officials and regulators than we ever did before. And it really came to a head with all of remember the TARP votes where looked like it was going to be approved, then it was voted down, then the Dow went down 800 points that day, and I talked to one of our senators, and the comment from, I'll say him or her, I won't identify which one it is, was that, Brian, you got to help us out here. What do we do? And I thought, wow, we're in worse shape than I thought. They were asking me. But I think, Bruce, we're much more engaged than we ever were. Our colleague Ed Bernard is the chairman of the Investment Company Institute. which is the trade association for all investment companies. So he's very active over in Washington, and Jim and I and a bunch of others mingle somewhat and talk to people somewhat regularly. But it's a much greater focus than it ever was before, where we didn't pay any attention to it basically 10 years ago. So whether people listen whether they hear what you're saying is a separate question. Yes.
Brian, I'm Paul Dykewitz. I'm the president of the Finance Club at Johns Hopkins. I wanted to talk about debt, government debt. We've had the problem of Greece now having junk bond status. Portugal's bonds were reduced in credit yesterday by Standard & Poor's. We also have the fear of a contagion spreading not only from those countries but elsewhere in Europe. And we have our own country, going into record deficits beyond what we ever could have imagined probably just a few years ago. Obviously, it affects the markets. Look at what happened yesterday. The market dropped below 11,000. It's trading down in Asia today. Some of the companies that were reporting yesterday had some of their strongest earnings that you could have imagined. Ford, one of the strongest companies so far this year. Great results. Stock goes down. So obviously the debt of what's happening in the countries other than the U.S. is affecting it. What is your view of the debt situation of governments and the likelihood of further problems in the U.S. and how that is going to affect the markets?
Well, that's really an easy question. A couple of points. Your comment about a company's stock being down yesterday, even with good earnings. The one thing we talk about all the time is things are up a lot over the last year and a half, generally. So it's not surprising to us when anything happens with a stock price on a given day. You've seen huge rebounds in share prices over the last year. So to the extent a stock goes down, if a company reports good earnings, maybe it's already reflected in the stock price. In terms of the debt question you reference, Greece is tricky. I've been struck by, up until last week, the headlines in the Wall Street Journal and the Financial Times on alternating days where Greece will be saved, next day Greece will fail, Greece will be saved, Greece will fail. And so in the last week, it's all changed to Greece will fail. And so I think, at the same time, I think something will be put together to keep Greece glued together, because the consequences of others' domino falling down are too severe. And many of the European banks, which got through the financial crisis relatively unscathed, have huge exposures, and I think they'll all act. And every time I see Joseph Ackerman of Deutsche Bank talking to Angela Merkel of Germany, I figure the fix is in for Germany to basically do something to keep Greece glued together. This is what classically happens with lower quality sovereign issues every now and then, and we've seen stuff like this before. I think they will try to keep Greece patched together at the end of the day, although yesterday it certainly didn't look like it, so time will tell. In terms of our own country, which is the tricky one, we actually just, one of our most capable colleagues just left us to go run the government's debt program over at Treasury. This is a woman named Mary Miller who ran our fixed income group, so she's basically in charge of bond issuance for the federal government, which is a very active, busy job. I shouldn't have my back to you, sorry. So she is very engaged in all of this, and her job, interestingly, is to travel around the world talking to the holders of our debt and talking about our plans and what we're going to be doing and how the deficit is going to be going down. Moment of silent prayer. So I think we have the wherewithal to get our house in order at some point. What we're seeing right now, when you look at the data, is a fairly significant pickup in Treasury receipts that are coming just from that better economic data that I made reference to. So the deficit will shrink cyclically, by the tune of a couple of $100 billion, just because the economy is slowly firming up. And hopefully we'll see some of that in the state of Maryland, because we have some of our own fiscal issues here. And then I think higher taxes are coming. I think the handwriting's on the wall just as clearly as we see this print right here. So I think we have the ability to do more on our deficit than a number of countries like Greece, which don't really have the economic infrastructure that we do.
We have a question here, Mr. Rogers.
Yes. Will.
Brian, maybe this is a truly easy question. You touched on the role of the rating agencies briefly. Could you flesh that out a little bit?
Full disclosure time, I'm an investor in McGraw-Hill, parent of Standard & Poor's. For the record, I've done some smart things in my life. This was not one of them. You know, Will, I think, again, to a lot of blame to go around commentary, the rating agencies did not perform as capably as they could have, particularly with respect to these complex instruments and the mortgage-backed tranches. In my view, did they do anything improper? Yeah, I don't think they did. They have rated debt instruments before that have gone bad. They might rate a low-quality junk bond issue that would end up in default, and they think it's a, you know, a single B bond or something. So stuff happens when you rate things, and there are good outcomes and bad outcomes. So I think they're under a fair amount of pressure right now. I can't conceive of global capital markets working without them, which is I guess that's an advantage for them, because you need to have a sane group or a partially sane group out lending a judgment on the solvency and strength of an issuer. And so someone's going to do it. And so I think they will find themselves less in the limelight 12 months out than they are now. Interestingly, their businesses are actually quite good now because there's so much issuance coming to market globally, and people are selling bonds and trying to raise capital, and so their business is actually quite good. I think in terms of the reform legislation, there will be a great deal of focus on the liability language and what are they liable for. Are they liable for gross negligence or just general negligence? And I think that's being worked out politically. They did not distinguish themselves, however, in my view. They are, in the hierarchy of blame, they are a ways down the list, in my view. Anything else before I get the hook? Oh, gosh. All right. Thank you all.